G'day guys. So welcome to what is going to be the Basis Trade Engine educational video series. So to date, there has been a lot of great success stories and a lot of awesome trades being placed by the community, but not a whole heap of education around the Basis Trade Engine, what to look out for, the different functions for someone who's totally new to using the Basis Trade Engine. Where do you start? What are you looking for? What really matters? And how do you actively manage the trade? Because obviously, when you're placing a basis trade, funding rates change, the market changes, and that can happen, in a second. So we need to be actively managing those trades and be aware of what the basis trade engine is telling us. So the focus of this video series is going to be around that, the frequently asked questions to date, and then building upon that and flowing through right to the end of executing a live trade on FTX. So I'll go through all of that and hopefully provide some insights into how to most efficiently use the basis trade engine. So focus of the video series, each video, so there's going to be 6 videos, this being number 1. Each video will be around 10 to 20 minutes long with the aim of touching on a different aspect of the trade engine. So session 1, what is a basis trade and how can you earn money from it? The trade types and products used, so futures products, spot products, shorting spot, margin trading, etc. Session 2 will be around accessing the basis trade engine. So if someone doesn't have access at the moment, how do you access it? And if someone has an NFT and is unaware of how to access the basis trade engine, we'll go through that as well, all in real time. I'll show you in these videos. Session 3 will be using the basis trade engine to scan for trade opportunities, things to look out for, like we just spoke about. The APR stability, borrows, are those borrows available, trade confidence, volume, and open interest. Session number 4, using the basis trade engine to execute a live basis trade on FTX exchange. So FTX being the most kind of accessible at the moment, so I'll show you on there. Obviously the basis trade engine shows a multitude of exchanges, but we'll just keep it simple for this video and you can expand once you're more comfortable with using the trade engine. Session 5 is effectively layering in and out of trades to maximize profitability. That is highly important in executing these strategies because most of the time they're on the less liquid coins. So coins like at the moment, like Radium, like Lux, SLP, coins like that are more illiquid when compared to Bitcoin and Ethereum. What is important with these basis trades is effectively managing your either getting short the perp or long the perp, or short the spot or long the spot. Either side, you can have slippage between your entry on one side of the trade and the other. So it's minimizing that and perhaps even getting a little bit of profit on that initial entry or finalizing the exit. So Adam has actually got a video already on that. So we'll show you that video for session number 5. Session number 6 is other useful data provided by the basis trade engine. So that would be coin analysis, funding data, and what we've got planned for future releases of the BTE. So right now we're in the alpha release of the BTE, but we're moving towards the beta version over the coming month. So that's what you can look forward to over the focus of this video series. So mostly educational and showing some live examples of how you can use it. So let's start with session number 1. What is a basis trade and how can you earn money from it? So let's flick over to this Medium article, which introduced basis markets back in the day around the NFT launch. The context of basis trading is that financial markets have been around for centuries. These fragmented markets have always offered opportunities, but with centralized, regulated, and opaque markets, these have often been reserved for institutions and sophisticated players only. So now with the opportunity of crypto is that, individuals, retailers can start to participate in these historically institutionalized trades, which are typically the most profitable and with the lowest risk. Markets have evolved hugely over the past few years. There are currently 518 exchanges listed on CoinGecko, offering over 10,000 different cryptocurrencies. And it's not just for hodlers anymore. These various groups are demanding new products and services to support their individual journeys, which exchanges are catering for with new markets. So new markets being derivatives markets, being perpetual futures contracts, being move contracts, so short or long volatility, being options markets. So One of those that is, highly liquid and traded with the most volume is the perpetual swap contracts. So perpetual futures contracts offered by exchanges now. So futures are an agreement to buy or sell an asset at a predetermined price at a specified time in the future. Traditional futures contracts had an expiry date when the asset would change hands or the contract rolled over, but perpetual futures simplify this by leaving the expiry date open or perpetually rolling until closed. So these contracts can be used for hedging and risk management, short exposure. Traders can bet against an asset's performance even if they don't have it, and leverage. So leverage long, leverage short. You have 10K, but you can get up to, it was at one point 100x leverage, 101x leverage. So there's been opportunities to make money on futures contracts for centuries, but with perpetuals futures and the speed and transparency available in crypto markets, a new generation of trade has been born. So this is where the basis trade comes in. So what does the basis trade take advantage of? It takes advantage of the funding rates that is paid from one side of the trade to the other. So whether that's bulls paying bears or bears paying bulls. So you may have heard of people talking about funding, contango, backwardation, etc., etc. It can give insightful context into the market. So is the market overly short? Is there a lot of selling pressure or shorting pressure, or is there a lot of buying pressure? So the funding rate is a mechanism that exchanges use to manage perpetual futures contracts and keep the perpetual contract in line with the underlying index price. So what does that mean? So a good example right now is Lux, because the perp is actually trading at a bit of a disconnection from the spot price. So what you see here is the perpetual futures contract. So that's a derivative of price. And let's compare that with the spot markets. So Lux USD on FTX. So same percentage scale. And you can see they're very, very close, but they're trading slightly differently. If we bring it down to the 5 minute, the perp is mostly trading beneath the spot price. So that indicates that there's a negative funding rate on the perp. So bears are paying bulls because that funding that exists to incentivize bulls to jump in the market is trying to push the perp back up in line with the spot price as it's trading higher than the perpetual contract. So the perpetual contract is trading below the spot price. That's a negative funding rate. If it was trading above, it'd be a positive funding rate. So you can see it recently has changed a little bit, but for the most part, if we scroll back, you can see it when it got disconnected here. All through there, the spot price is trading higher than the perp price. So what does the market need to do? What does the market maker need to do? They need to incentivize the longs to step back into the market and bring the blue line here back in line with the orange line. So bring the perp back in line with the spot price. So that's what the funding rate is there for, and that's how exchanges use that funding rate to incentivize the market to adjust itself and bring both products in line. So bring the spot product and the perpetual contract in line and trade at a very similar price. And players, market players can take advantage of that. So if you're long Lux right now with a negative funding rate, you're getting paid to be long. So the shorts are paying you because there's that disconnection between the spot and the perp. The opposite is also true if the spot was trading below the perp, that would be a positive funding rate. So again, it's first and foremost, it's a mechanism that exchanges use to manage perpetual futures contracts and keep the perp in line with the underlying index, so on the underlying spot price. So they're periodic payments made between traders who are long or short a particular asset, helping to balance the demand between the buy and the sell sides of the market. So essentially it acts as a fee or a rebate on your trade, encouraging some traders to take the side which pays them the funding. So on that example of Lux just now, you can see that the spot is trading in at a premium to the perp. So that means the market maker is going to incentivize the perp to come back in line. So what do they have to do? They have to pay longs to get long and start to bring that market back in line with the spot price. The price of the perpetual swap is greater than the underlying. The funding is positive, so when it trades above the spot, it's positive. If price of the perpetual swap is less than the underlying, the funding rate is negative. So we just went through an example there. So what is the opportunity of this? Well, I think we just touched on that. So the funding rate that exists. But the issue with that is the funding rate exists, but you're still exposed to direction. So if we get long looks right now to take advantage of that negative funding rate, you're going to be exposed long. So you're total naked long, but you're getting paid that funding rate. How do you mitigate that risk of being long in the market dropping 50% while still maintaining that exposure to collecting that yield or that funding that exists on that trade? And that's where the basis market trade engine comes in, and what we do at Basis Markets comes into play. So just explaining further on the leverage side of things. So when you buy an asset on 10x leverage, you didn't think that the money for your 10x position was free, did you? The exchange isn't providing this liquidity for free, but neither are they taking your fees. They're paid to market participants taking the other side. So it's incentivizing the market players, the market participants, to make the market, to provide liquidity to the market instead of the exchanges doing it. That's a big funding, a big driver for exchanges to run with this mechanism. They don't have to use their own liquidities to make the market. It incentivizes the market participants themselves to participate and to make that market and provide liquidity. The benefits of this is high returns. The basis trades, so where we're mitigating that risk of being either naked long to collect the funding or naked short to collect the funding, we're trading with zero directional risk. So we're taking the other side, and we'll go through that shortly. There's no impermanent loss like traditional yield farming. Light touch management, there's only hedging here and there. There's no need for frequent hedging. Diversified exposure using trusted centralized exchange and decentralized exchange platforms. So typically these APYs, APRs are insanely high, so 100% plus, even up to 1,000 or more, some ridiculous returns. But the risk is that you're trading those really shit coins, and you're trading on sometimes some decentralized exchanges that are a little bit dodgy. So with the basis trades, you can execute them on FTX, Binance, all of those trusted players or venues in the market where you know what you're going to get, or at least you have a good idea of what you're going to get, and you can feel a bit more secure. And longer lasting returns, so not having to jump into a new pool every 24 hours as you would with leverage yield farming or yield farming. So why isn't everyone doing this? Opacity, there's a lack of awareness around non-directional, delta neutral strategies. Large players use strategies like this as the bedrock of their returns, but this alpha isn't normally shared with new entrants. Perceived complexity, while the concept these strategies use are easy to understand, they're not as simple as buy low, sell high, and some people miss out because they don't want to learn a new skill. Impatience, triple-digit returns are exceptional by almost any standard, but may seem slow compared to leverage trading, for example. As an active trader, if you're following the classic risk management policy of 1 to 5% per trade, that leaves 90% of your portfolio, which can be used for these non-directional strategies to make sure that you're maximizing your gains and building your portfolio every day. So we go on to say, imagine your stable portfolio or collateral multiplying by 2 over the course of a year without needing to trade every day. So that's where Basis Markets comes in, and that's where the BTE comes in to help you execute these non-directional trades and collect that basis, that premium that exists between the spot and the perp price. Or even you can execute these trades with a traditional futures contract as well. So we'll go into that a little bit later. Checking in to see if we've covered most of that for session number 1. So what is a basis trade and how can you earn money from it? Trade types, products used. We'll go into the trade types a little bit later when we start to look at the basis trade engine. The products used, you've got your futures contracts, your perpetual futures contracts, and your spot products and margin trading. But we can go into that in the next video. I think that's a good overview. So that's video number 1. We'll conclude that there. And the next video, we will touch on accessing the basis trade engine from the Basis Markets website, what you need to do to get involved and actually have enabled access on the website, who can access it, how to do so, logging in, and we'll go through those trade types and products used that the Basis trade engine does show you.